Now, let me introduce Mr. Manish Gunwani. People who have dealt with mutual funds, who have been in this industry for some time, for them, Mr. Manish Gunwani needs no introduction at all. I'll go through the paces still. He is a graduate from IIT Chennai with a BTech. He's an engineer and he did his PG diploma in management from IIM Bangalore. He has over 21 years of work experience, primarily in equity, spanning roles in equity research, fund management, etc. Before this, actually, he made his very, very big name in ICICI AMC. He managed two flagship funds of the mutual fund of that mutual fund company, whose assets grew from 1 billion to 5 billion. 5 billion is huge, and that too just in 5 years. One of the funds grew from 50 million to 3 billion, 6 times, becoming the second largest fund in the entire mutual fund industry. As Deputy CIO, Chief Investment Officer, he's instrumental in various aspects of asset management, like setting up research processes, product strategy, developing talent of the team, etc. And he has immense experience in equity research. So you see, and now for the past about 2 years, he's been working in a portfolio management company whose focus, he was working in a portfolio management company whose focus was mid caps. Now, mid caps are the real research funds, mid caps and small caps, right? So this session is coming to you from a person who's managing hundreds of thousands of crores. So it is from, as we say, though I don't like this connotation myself, from the horse's mouth. He is going to speak on something which has become very popular lately, that is international investing. Lots of times people ask us, if foreign markets are always there, what's so great? Why is everybody suddenly shouting about foreign markets today? So is this another trend hype being created? So these and many, many more questions is what we'll hear from Mr. Manish Gulwani. Manish ji, please take on.
Thank you. Thank you for that very kind introduction. I'm sure this is a day of immense wisdom, immense knowledge that has been shared. So, I have been asked to talk on global investing. I have divided into two parts. One is why to invest in international funds, and the second is how or how not to invest in international funds. So, let me start my presentation. So the first section on why we should look at international funds. Now, I'm sure over the day you would have heard how important asset allocation is. I'm not going to spend too much time on that. Just suffice to say that over long term, obviously in investing, this is the most important thing. It needs to have a bit of a process and effort from everyone. I think Indian families in general don't look at financial health in the same process oriented strategic way, whereas if you look at physical health or anything else, people obviously spend a lot of effort, but in terms of defining their financial goals, defining the risk you can take, defining the volatility you can take, defining what kind of cash flows are incoming, what kind of cash flows are outcoming on a 5-10 year basis. That is a very important part. And when we're looking at international funds, obviously it's part of our overall asset allocation mix. And as this quotation by this famous investor Ray Dalio says, when we allocate to different assets, we have to assume that we don't know how future will be, because the future always surprises us. So 2 years back, could any one of us known that COVID will dominate our lives for so long? I'm sure no one could have predicted this. So our asset allocation should not be based on what is hot today, what is selling today. It has to be based, customized. You can do it yourselves, you can use an advisor, but it has to be done in a customized manner for you. So moving on, just starting with how India overall has allocated assets in a sense. So this is obviously the slightly rough data because real estate is difficult to value. But essentially, when you look at India, there are few things. One is that India is a very savings rich country. Now, at least the top 10-20% households over last 3-4 decades have built up a solid asset base, because if you see overall assets in India broadly around 600 lakh crores, and there's not that much debt in households. So the issue is property and gold obviously are still very big part of this asset mix. It is not surprising given that at this stage of development, when inflation was high in, let's say, 1947 to 2000, inflation was very high, people were poor, they didn't have long term cash flows. But over time, as we are developing, we are obviously seeing that the financial assets are getting more and more share out of this overall asset mix. Now, if you look at different asset classes, how do they stack up on various key parameters? When we look at volatility, which basically, if you think about it, is how much does the price of that asset fluctuate? Then equity is obviously very volatile. We all know that equity markets can be up one year, down next year. Fixed income obviously not volatile at all, because you get a fixed, your bank FD gives you a certain rate of return. Property and gold are somewhere in between. But on return, obviously equity, as the long term data shows, anywhere between 12 to 15%. Fixed income anywhere between 5 to 7% pre-tax. uh, Property and gold long term returns have been somewhere between 8 to 10% on a 20-30 year basis. So equity is definitely the best on return. In terms of liquidity, that is, how easily can you sell that, how easily can you monetize what you own, what are the transaction charges, what are the taxes, etc. um, I think equity is obviously very easy to sell. It's got very low transaction cost. Taxation is quite efficient. Fixed income as well. Property and gold, obviously not very easy. There are stamp duties on property. Gold, if you have jewelry, a lot of loss in making charges, etc. So broadly, this is the overall kind of attributes of each of these existing asset classes. Now, when we talked about asset allocation, as I said, basically we should assume that we don't know anything. This is because if we see over fairly long periods of time, each of these four major asset classes, they have gone through their own tough times. Now, I live in Mumbai, and I know, and I'm sure this is true of most major cities in our country, that from 2013 to 2020, many properties have broadly given zero, some have been negative also. That is, the capital value of the property has not appreciated at all. So it has been a fairly bad investment, real estate, over the last 7-8 years. If you look at gold and go back to see what gold was in Indian rupees, in 1992 it was 4,100. 10 years later, which is a fairly long time, obviously, it was still 4,200 or 300. So virtually flat for a long 10 years. When you come to fixed income, let's say your bank fixed deposit, obviously it gives you a certain interest. But when we look at return, obviously we have to see it against what is inflation. And when you go back to a period like 2009 to 13, when inflation in India was running at 9-10%, then bank FD rates were much below that. So effectively, you were not generating any what we call real return, because if your interest is less than inflation, then effectively your wealth is not increasing. If you look at equities also, they also go through fairly long cycles. Some of them are very challenging cycles. So if you look at the BSE mid cap index, 2007 January, if you had sold it, you would have got it back 7 years later at the same price. So the reason I'm giving you all these examples is it is necessary to have a balanced asset allocation mix. When all these phases happened, none of, I mean, it's not very clear before the phase that this asset will suffer so much, right? So we don't know how future is. We don't know what events happen, what macro trends, your interest rates, oil prices. So there are many uncertainties in life, and all these assets, they go through different cycles, which is why it's very important to have a judicious mix. So when we look at international funds, I think a key part of it is what is our view on the Indian currency against other currencies in general. Obviously, dollar is the most important currency. Now, usually theories don't work in markets, but long term, at least in forex market, it has broadly played down by theory. So I'll just tell you why. Now, the theory says that if there are two countries, let's say USA and India, then if USA's inflation is less than India, then India's currency should depreciate to match the difference in inflation. So the logic is this, that if you have a product which is the same product and it's costing $1 in US, it will cost 75 rupees today because that is the currency rate. Now let's assume India's inflation broadly is around 7%, which means in 10 years, the price or the cost of their product doubles because of inflation in India. So 75 will become 150 after 10 years. And let's assume that US has zero inflation, so after 10 years, it's still $1 there. Now it's the same product. So the only way it will match is rupee has to go from 75 to 150, which is basically saying that the country with higher inflation should see its currency depreciate. Now that is the theory. Now a lot of times in markets, theories don't work, and they definitely don't work for the short term. So if you look on a 1, 3, 5-year view, this will not work. But if you see the last 30 years of data, I looked at the consumer inflation in India. It is average of 7.1%. The last 30-year consumer inflation in US is 2.3%. So the difference is 4.7%. And if you see what has actually happened to the rupee versus dollar in the last 30 years, it has gone from 18 rupees to 75. So pre-crisis in 1991, end of 1990, it was about 18 rupees. Today it is about 75 rupees. So that over 30 years, actually 4.2%. So from a theoretical 4.7, 4.2, obviously it is quite close. So you could say broadly theory has worked. And if we use the same theory today, the US central bank Fed targets an inflation of 2%. RBI, which is the Indian central bank, their target of inflation is 4%. Now, even if you assume India inflation turns out to be a bit higher, you could say somewhere between 2 to 3% is the annual depreciation in rupee that we should expect when we are looking at the long term, maybe 5 years, 10 years, 15 years. Now, I should tell you that generally the path is not as per theory, in the sense that it's not that every year we will get this whatever 2.5%, 3%. It obviously will be that 3, 4 years nothing will happen, then 1 year big rupee depreciation will happen. But I think when we are looking at asset allocation, obviously we take the long-term view, and this is a good framework to think about the currency. Now, when we're looking at international funds, we're looking at an asset class. So what should we look at an asset class? One is return, two is risk. Return should be high, risk should be low. it should have liquidity and accessing it should be easy. See, for example, art is also an asset class. Some real estate in Africa might be asset class, but frankly, you and me can't play these assets because it's not easy to get access to these asset classes. Fourthly, important from a very important from an asset allocation perspective, that it should have low correlation with existing asset. See, if I own an asset and a new asset class is broadly mimicking the same behavior, then even if it is more volatile, instead of buying that, I can still buy 2 units of this instead of 1 unit of the new asset class. So it doesn't make all that much value addition to my existing portfolio. But if it has low correlation, that if, for example, if I have a lot of investment in Indian real estate and this international fund is having a low correlation, then it obviously is something I should look at, because the more diversified you are, that is the lower correlation between what I own, then the steadier return I will have in my overall portfolio. And finally, when we look at an asset class, it is very customized to the investor needs. So for example, today a lot of kids are going to overseas to study, whether it's US, UK, Canada, and then obviously there are a lot of expenses required in those currencies. So if someone has these kind of liabilities, then you obviously need to have a higher proportion of international funds, because at least your currency risk will be diversified more. So when we look at asset class, there is a more general view, but there is also something which is specific to the individual, which has to be addressed. So when we look at, let's say, global equities, evaluating it through some of these attributes, now I'm just using MSCI World, which is basically about 1,500 largest companies in the world. 65% is US, about 10-15% is Europe, Japan, etc. Now, this is a very widely known index. A lot of big ETFs globally are there in MSCI World. Now, if you look at the returns of this asset class, inception 1987, from that point, it has delivered 8.5% in USD terms. Last 10 years has been 11.3% in USD. Now, if you see historic rupee depreciation been about 4.5%. So this has delivered 13 to 15% in rupee terms over very long periods of time, which is, I think, a very healthy return. More or less in line with Nifty, but obviously there have been years when Nifty is not done well, this has done well, etc. Uh, Coming to correlation with Indian equities is medium. There is correlation, but it's not super strong. But obviously, the correlation with real estate and gold is very low. So, for example, last 5-7 years, MSCI World has done pretty well. Real estate and gold, as we know, have not done all that well. Thirdly, against Nifty, it also provides rupee depreciation hedge, because, for example, if you see Nifty, when rupee depreciated a lot in 2010 to 2017, rupee went from 42, 43 to about 68. Uh, Nifty in dollar terms was actually flat, whereas MSCI World had generated about 8-10% per annum return. So rupee depreciation is obviously something which is a big benefit with these international funds. And in terms of liquidity and access, it has now got much better, because both through brokers or through mutual funds, you can access it pretty easily. It is all online. You can buy and sell quite. There is no liquidity problem. It is a very big asset class. So obviously things have improved a lot on the liquidity and access viewpoint. So overall, when you look at the attributes of this asset class, I think broadly, I would say that sophisticated investors in India should have maybe 5-10% at least in international funds in general. But obviously, a lot of it depends on customized requirements. But there definitely seems to be merit in return correlation, etc. Now, moving on to the implementation part, or how or how not, I'll just uh, talk a bit about what are the issues here. Now, when you're looking at global equities, what are your choices? Now, you can either directly buy stocks by registering in brokers like E-Trade or whatever global brokers. You can directly buy ETFs rather than buying single stocks. Third option is to buy international funds of mutual funds. Now, what are the issues around all these? One is that obviously when you're buying stocks or ETFs, you need to spare time, you need to have expertise, you need to do your own research. Second, very important is when you're directly buying stocks or ETFs, it goes through what is called a liberalized remittance scheme of RBI, which is basically that any individual can maximum send 250,000 US dollars outside the country. Now, this LRS covers things like travel, sending money to relatives, sending money for education, or buying these kind of investments. In the last budget, there is also a tax collected at source above 7 lakhs for any LRS remittance. And that obviously kind of increases the friction a bit. Uh, Thirdly, you have transaction costs. So you have to have some account opening charges, you have brokerage charges. And if you're doing it directly, you will obviously have to take the money back. So you will have Forex because you will keep converting dollars to rupees and rupees to dollars. So there'll be some Forex charges as well. Important point on tax. Now, if you directly invest in stocks, what are the tax implications? So it is treated like a unlisted security. So long term here is defined as more than 2 years. Tax rate is 20% with indexation, and short term is your marginal tax rate. Uh, Dividends may get taxed at source in foreign country, and you can then get credit based on the taxation treaty with that specific country. If you go through the mutual fund route, it is treated as debt taxation. So long term is more than 36 months. Long term rate is 20% with indexation. Short term is marginal tax rate. Dividends too are at marginal tax rate right now. Now, what are the types of international funds available? These are all the various types. So you have a sector fund, like there are some funds which are dedicated to the mining sector. Then you have thematic funds, where a particular trend is being backed. So you have funds for emerging markets or technology, the FANG funds, etc. Right? Investing in Facebook, Google, Apple kind of stocks. Then you have single country funds, China, Brazil, etc. Japan also. Then there are region funds, Asia, for example. The most diverse fund is a global fund, which will be something like investing in MSCI World, where it covers all regions, all sectors. And finally, you also have some multi-asset funds, which will have some exposure to global equities, but also offer a mix of either domestic equities, gold, debt, etc. in that mix. So how should we evaluate these types of funds? Obviously, the funds which have narrow focus will be more volatile and risky. So, for example, a single country fund where the geographical focus is limited to a single country. Now, the economy of that country, the currency of that country will obviously be more volatile than a fund which is more diversified in geography. Similarly, if you have thematic style like FANG stocks or let's say artificial intelligence stocks or emerging markets, um, thematic styles are obviously again more volatile. And if it's a smaller theme, then obviously the volatility will be even higher. Thirdly, volatility is also high if it's just one sector like mining or banking. Um, Overall, I feel that most investors should look at either global equity funds, which invest in equities across the globe. They invest in the largest companies. So something like that MSCI World Index and multi-asset funds, which are more diversified. They are preferable for most of the investors in India. Important point is, see, you are using this as a strategic diversification tool. It gives you reasonable return. It gives you hedge against currency. So if it is strategic, then don't look at it from a 1 to 2 year perspective. Also from a taxation perspective, it is debt taxation, which means below 3 years the tax rate will be high. If you hold on for more than 3 years, your taxation is more efficient. So when you look at these funds, I would recommend that please don't look at it from a 1 to 3 year perspective. Look at them from a minimum 3 to 5 year holding period perspective. So just to summarize, global equities or international funds, I think overall they definitely warrant some allocation because returns are good, correlation is low to Indian assets, and a lot of times we may have liabilities in overseas currencies, which can be taken care of. Second, overall, I feel that going through mutual funds will save you a lot of time and effort. It will save you the LRS, the liberalized remittance scheme issue. So it's just more convenient, I feel. Thirdly, as I said, basically stick to funds which are more diversified across sectors, across geographies. And finally, look at these funds from a very strategic view. Don't look at them from a short term view. With that, I'll end my presentation and take questions, please.
Thank you very much, Mr. Manish. You've taken us through a vast canvas, dealt with everything, and I'm very sure the attendees of the webinar have gained a bit. Like whatever doubts I think they had, they have been cleared to a large extent in the vast canvas that you painted. Now, I have one question. One question that readily comes to mind is that we have not discussed about the currency fluctuations. What is the impact of currency fluctuation on international investments? So whether you do it directly or you do it through some foreign brokerage who's in India and investing your money abroad, or if you do it through mutual funds. So there, even in mutual funds, there would be currency implications. Can you throw some light on this?
Sure. So I had a slide on currency, and I think that's a very important point you're making about that being a big part of the thesis of investing in international funds. See, as we have repeatedly said, future is uncertain, and it could happen. For example, that the Indian currency may depreciate a lot in next 3 years, 5 years. So it's good to have some allocation to funds which actually benefit from that currency depreciation. So these funds, since they invest in dollar assets, let's say, so if rupee goes from 75 to 100, these funds NAV will actually benefit because it is basically the return in dollars plus the currency depreciation, which is the total return. So if the MSCI World, for example, if you invest in MSCI World ETF, And if the return is 8% and currency depreciates at 4% per annum, then total return will be 12-13%. So that diversification you definitely get with international funds. Over long term, my view is that last 30 years, Indian currency has depreciated at about 4.5% last 30 years. I think it may depreciate much less next 10, 15 years, maybe 2.5, 3%, but it will, because we are still a higher inflation country than US. So if I look against the dollar, theoretically, Indian currency should depreciate against the dollar. And I think that over long term, that will play out. But yes, that is why I said that when we look at a new asset class, it has to give you some lower correlation with existing funds or existing property, gold, whatever you have. And the fact that these funds benefit from rupee depreciation is definitely a plus in that sense.
Okay, right. But now that you are talking about currency devaluation, uh, that view is slightly under a cloud. That at least in the short term,
Yeah.
whether there will be a currency devaluation or upgradation just because of the huge amount of QE that has gone in US. What do you say in the short term? Let's say about a year or two, if we talk about.
No, I agree. So the reason I presented long-term data is the currency markets work in stops and starts. They have very jerky movements. So I think next 1-2 years outlook on rupee is quite positive, because we are coming out of COVID crisis. Economy is expected to grow. Um, we have had a fairly soft patch for last 5-7 years. In fact, from a macroeconomic growth perspective, I I am hoping that we don't see anything untoward like COVID in the next 2-3 years. So if India is growing faster, US current account deficit is increasing. They have done well for last 10 years. The dollar also has done well for last 10 years. So you're correct that from a cyclical perspective, I think rupee will do well. But as I said, our strategic asset allocation has to take a 10-15 year view. And that view still has to be based on inflation. Whether if we are higher inflation than US, then I think over long term we have to expect that rupee will depreciate.
Okay, right. Thank you very much. Thanks a lot, Mr. Manish. The last part, the currency part, is something that people have often asked us because they read in CNBC and so many other things. That rupee is going to depreciate, and suddenly the next day rupee appreciate. I mean, USD is going to depreciate, and suddenly they find it is continuously going up. So there was a lot of question mark. So I'm really grateful to you for this very informative session. And once again, very sorry for
No,
having
no,
made
fine.
you
It's
somehow.
been it's been an absolute honor to present to the armed forces. Thanks a lot for the time.
Thank you very much. Thanks a lot.
Thank
Grateful
you.
to you.